So what's the future like for Truecap? What's the number target? Right now you've serviced 300,000 customers.
We obviously want to service more than 1 million customers by 2030.
There's a lot of conversation over the last 5, 7, 8 years. MSMEs have suffered.
Whatever you've said is 100% right. We feel that the MSMEs of today are constantly striving to,
A large Reliance or Adani or somebody comes in and enters this space.
India has always been a competitive market. If it's not competitive, there's something wrong with the geography or there's something wrong with the product. See, wherever you see tremendous opportunity, it eventually results in chaos.
It's really fantastic. 50 crores to 1100 crores is a great journey.
Post INFS and right before COVID, there were certain months, truthfully, we didn't even know whether we'd have money to pay for salaries.
Hey guys, welcome to the third episode of the second season of our podcast. We're here with a really interesting guest, Mr. Rohanjit Singh Janeja. He's been a hedge fund investor and investment banker for 17 years, and he is now the MD and CEO of Truecap Finance, one of the fastest growing NBFCs in the country that's helped over 100,000 borrowers and over 300,000 borrowers in its lifetime. And he's here to talk to us about Truecap Finance. So thank you so much for joining us on this podcast. Love to know a little bit more about you and how you've reached into this position.
Thank you so much for having me. Firstly, I would say, it's been a fairly interesting journey over the course of the last 2 decades for me, at least. Having been born and brought up here in Mumbai, my parents always had an aspiration to send me abroad for an education. So that's what took me to the US in 1998. Post that, after completing my undergrad education there, worked for an investment bank for 4 years, covering financials in the US. And then, interestingly, my former boss recruited me to a hedge fund called Front Point Partners. Little did I know that going to Front Point Partners, I would be part of a team that eventually got featured in the book and the movie Big Short for accurately predicting the 2007 and 2008 crisis in the US, the housing crisis that eventually ensued into the global crisis post that. That was a very interesting time for me. I think my first year at the hedge fund was just finding my feet, and the job that they put me on immediately after joining was crunching in all the data for the housing stock in states like Florida, Michigan, etc. And little did I know that it would percolate into a position that they held a very strong conviction in, that there was an imminent housing crisis in the US, and that there was an oversupply of homes. People who couldn't afford those homes were buying those homes because mortgages were at almost 0% at that point in time, and there was just excessive lending ongoing. So that was very interesting. Was with Front Point Partners for about 4 years. We also did a lot of investing in Indian equities at that point in time, along with investing in global financials. That's what led me to the next hedge fund opportunity, which was Seawolf Capital.
So just before we get on to Seawolf, I have a question I've been dying to ask you, because Big Short is one of my favorite movies. Is it like, did the way Front Point invested and the positions that they built in the 08 housing crisis, is the way it was portrayed in the movie how it actually happened? Is that how Front Point and hedge funds in general actually work?
So the Big Short covered 5 different funds in the movie. I would say, at least I can speak for Front Point, what was depicted of Front Point and our team especially, which is the financial services fund, it was almost 100% accurate.
Really?
So, I think interestingly, you have to have the support of a team that has thorough conviction, number one. When you have thorough conviction as well, you could always be wrong. So that's something about a hedge fund, especially when you take a short position, because the majority of positions people take are usually long positions in the investing world. Being short is a very courageous thing to do. It's not easy at all, and it requires a lot of not just courage, but a lot of guts. So having that conviction, I think the team stuck together and had that conviction holistically. That's number one. At the same time, there were some people who had a lot more courage to say that I want to play this out right till the end. But you also had other players who were more even-keeled that said that, listen, you are only as good as the counterparty making good on the trade. Right. So how do you balance that out, right? Because you could be 100% right, but you don't get paid on it.
Right.
So that was there. So I think the movie very accurately depicted how the fund was, what they showed in terms of team members who went down to states like Florida, etc., to see if there was a glut of homes that were completely unoccupied. to also understand the kind of conviction we had post looking at the data. So, data, like I always say, and I've done that extensively while I was at Front Point, you can go through reams and reams of data. It's not about what you see in the data, it's what you make out of the data. That's the more important part. So they kind of were able to connect the dots, which is extremely important because that was where what gave them conviction.
So did you go on that, Florida trip where I think Mark Baum met the mortgage brokers, and I think there's this famous scene with the stripper and the 8 houses and 8 mortgages. Were you part of that
No, I
trip?
was not part of it. That was a different fund. But what they showed about, my former bosses having gone to Florida, Porter Collins, Vincent Daniel, and obviously you had Danny Moses, you had the portfolio manager who was everyone's boss, Steve Eisman. So I wasn't fortunate enough to go down to Florida with them, but we heard of all the stories firsthand when they came back from Florida. We heard of all the stories when a person like Steve Eisman, the portfolio manager, met with the CEO of the large firms that were very bullish on the housing um, mortgage industry at that point in time. So a lot of those, I've lived through it, at least hearing firsthand anecdotes, and when they came back to the office, the experiences that they would share. But I've never been, I was not the one that went down with them to Florida.
That's very, very interesting. And just one final question, because I remember this from the movie as well. Uh, when the time came to close the short position, there was this whole scene where there was a lot of angst about, I think, Mark Baum not really wanting to close that position. Is that truly how it played out? Was there a lot of conversation, no, we should just let this run?
Yes, so there was a debate, at least for us at Front Point Financial Services, to close out the position. The reason being that, it started looking so shaky that you didn't know if the counterparty would have the adequate resources to pay you back the money. It seemed like everything was going down a hell in a handbasket. So there was I wouldn't say heated debate, but there was a very good debate internally as to how long we should stay on to the trade. Perhaps, the team could have left some money on the table, but eventually it's always good to be prudent in these situations. Sometimes it's good to be conservative. So it was a very real situation. It was a very interesting dialogue and debate that we had internally in the team. And hats off to the team, my all my bosses over there. That firstly they had the conviction, and number two is after having the conviction and being proven right, you actually get off the trade and get paid for it.
Yeah. Yeah. That must have been one hell of an experience to just, at least, relatively early in your career, to see something like that play out.
I was all of I was all of 27 when I 26 when I joined Front Point. So like I said, as a 26-year-old boy in the first 1 year, just crunching that data, and then eventually started covering Indian equities, etc. But for the first 1 year, it was literally like a very surreal experience. I would say, like, sometimes things come to you, hindsight's 2020. In hindsight, you realized whatever I was doing, while at that point in time, I must have thought it's inconsequential because it was just data crunching. But how important that data crunching was, or the numbers that we saw in the data, why it was always told to me that if you see something, you have to say something. Like, you don't just put in the data. And I think that was my first big learning experience with data, that data is not just putting in something, it's about what the data says to you, right?
Yeah.
How you analyze the data. So I think that was great. And again, full credit to my bosses, my former bosses, who gave me that guidance, who taught me that you have to be able to connect the dots.
Oh, that's fantastic. I think from there you've just gone, from strength to strength. So you mentioning after your time with Front Point, there was the next hedge fund opportunity. Love to know more about that as well.
Sure. So at Front Point, we had two different funds. One was a larger fund. The other one was a smaller fund that invested predominantly in mid caps and small caps. So from there, we did a lot of investing in Indian equities, which was my first real experience with investing in India, because I lived away from India for almost 10 years at that point in time. So we invested here. We were largely in PSU banks at one point in time. That we went into private banks. We did some real estate companies, and then we started covering NBFCs. I think that's where eventually then we started a new fund called Seawolf Capital. Seawolf Capital, the mandate was to invest in mid and small cap companies. So seldomly did we do large caps. It was predominantly mid and small caps. And that's where the real brush with understanding the operating nuances of a business as well in different countries came for me. So we specifically invested in two names in India, which were more of a recapitalization story. in the NBFC space. And that's where, there was a germ or there was a seed born inside of me saying that this is something that I really want to pursue at some point in my career. Little did I realize that, that happened in 2012, that in 2015, then my family, my wife and I made a decision to move back to India, both personally and professionally. And personally, we just thought we'd lived in the US for very long. Let's move back to Asia. If you had to move back to Asia, why not move back to India since our families are from here? Yeah. And I was born and brought up here. And number two is the fact that professionally, whatever I wanted to do, having invested in Indian equities, I thought, where else would I be able to do it other than India? So why move back to any other country in Asia? Why not move back to my country, which is India? And that's what brought us back here. And as luck would have it, as whatever one may say, I'm very fortunate to be given this opportunity to be at Truecap today, where I've been for the last 4.5 years, and it's exactly what I wanted to do back in 2012 and 2013 when that whole journey started.
That's fantastic. But I want to go back to Seoul for a second, because I think from what we've spoken a little bit off camera, you were involved in another major event in NBFCs in India, particularly the SKS Microfinance recapitalization. It's one of the most interesting stories of the NBFC space and the Indian business space. So I'd love to get your perspective on what happened there, what went wrong, what went right, and how it's unfolded in the time since, and what your participation in that was.
So that was a very interesting story. I think what happened at that point in time is there was an ordinance in the state of Andhra Pradesh where, unfortunately, they couldn't do any more lending in the microfinance space, because of which a lot of companies had to write off a certain percentage of their loan book. If you can't lend further to microfinance customers, a lot of the customers won't pay you back your money. So that's the nature of a lending business. We were part of the recap, not part of the IPO when they did that in 2009. This was in 2012. And really understanding the nuances of a business when the sector and the business are down and out is a different experience altogether. So like they say, a rising tide lifts all boats. Right. In good times, when there's an IPO frenzy, when there is something which is 20 times oversubscribed, 30 times oversubscribed, etc., a lot of people, be it investors, retail investors, be it institutions as well, I won't say that they don't do enough work. They do a lot of work, but you also take comfort in the fact that there are a lot of other people riding that same tide with you. Yeah. When things are down and out, and that time you have a complete crunch on raising capital, whoever's investing the capital, you have to be, want to make sure you're extremely thorough, because you could go wrong, which you could go any other way as well. But you're putting a lot of trust then in a company, which is, almost like a rebirth of the company in many ways. So we took a very conscious call. I think we were one of the only hedge funds that invested along with the existing private equity investors at that point in time in 2012. And then they did a follow-on offering in 2014, post the new government coming into power. They did another capital raise right after that. But I think from 2012 to 2014, there was a complete transformation in the way business happened, number one. Number two is the sector was also going through a crisis. So how the sectoral players were dealing with, at that point in time, what was called CDR with the banks, how SKS navigated its way without defaulting on even 1 rupee of debt throughout the tenure, despite writing off 40% of the loan book. That showed us a lot about the company. The resolve the company had to, lend to its borrowers and make sure that they risk mitigate and diversify into other states as well, so that they won't have this kind of a crisis ever again. I think those are the kind of things that taught you a lot. Also then, obviously to monitor the investment, etc., would make frequent trips to India. So I think going unannounced to those joint lending group meetings as an investor, just seeing what is happening, how it's happening, that was most important. So I think, as an investor, what you look to do is very apparent. Why you look to do certain things also is very apparent. It's about how a company does things that makes your investment thesis real.
Yeah.
So how they were doing things, or how some other companies were doing things to actually realize that there is a tangible investment value, or there's a tangible benefit you could actually see at a much later stage. That's what gave us the confidence.
That's so true. I think the what and the why for most companies is very simple. The how is really The how is how you differentiate the winners from the losers. It's truly all about execution. But let's come to Truecap, because now that's where you've been at for I think 4 years, if I'm not mistaken. What's the journey been like with Truecap?
Very interesting journey. I would be lying to you if I say that everything is hunky dory at every point in time. So, firstly, I think the one thing which is very apparent to me, and I'm sure it's apparent to most other people who are part of NBFCs, is that as an NBFC, you will always be constrained for capital. So, capital, both raw money capital and human capital, is a raw material of our business. As money capital, we will always be constrained relative to banks because we can't take deposits. You're a non-deposit taking NBFC. So you have to rely on the wholesale market, on capital markets, and on banks to give you money at every point in time to grow your book. So you have to make sure that you're growing at a prudent pace where you will have a lot of cyclicality from time to time. That's the nature of the beast. That's the business. So, starting this from ground up, I joined them when it was about just under 40 crores. We're at about 1100 crores today. I would say it's been a mind blowing journey, and it's had its shares of ups and downs. It's had its cyclicality. So when we started, you had the INFS crisis. Post the INFS crisis, literally 17, 18 months after that, you had COVID. How you survive through COVID, because you have to come up with ways to continue to generate revenue or to cut costs. Truth be told, there are only so many costs you can cut. So how do you generate revenue, more importantly, so that you can survive, was a very interesting part of this journey. I would say post ILNFS and right before COVID, there were some certain months, truthfully, we didn't even know whether we'd have money to pay for salaries at the end of the month, right? But in some shape or form, you survived. Then how you rejigger the business model, and then COVID comes around. When COVID comes around, we were fairly fortunate that our focus on what we call the essential goods category, which is basically lending to retail mom and pop businesses within the MSME ecosystem. So think of kirana stores, chemists, cloth traders, shoe retailers, plumbers, hardware stores, manufacturers and retailers of wires that go to your computers and telephones. Kirana stores and chemists were open during COVID. So we literally got an unexpected uh, uh, lease of life in that way. And then we also got a lot of new business that came along our way. Plus, we were able to raise debt and equity. So it was, you always have to be ready for the unexpected, and you always have to find a way to be creative to survive.
Yeah.
When you're small. So it's been a very interesting journey. I think, when you're much smaller, especially for us at Truecap as well, initially it's always about the people.
Yeah.
Eventually, then it has to become more process oriented, right? So you have to move away from just being completely reliant on people to being now completely reliant on processes as you become much bigger. So a lot of other things take much more precedence as you grow bigger and bigger. We're still fairly small today, but it's, we're up to a size today where, earlier we had problems of being small. Today we are having to you have certain other good problems of becoming slightly larger. So that's the journey.
Well, you always have some problems. There's no problems, there's no fun, right?
Fun. Yeah.
So I want to maybe just roll back a little bit and talk about this decision to lend to primarily essential goods MSMEs, is I think how you put it, or essential service MSMEs. Why that segment? Why those borrowers?
So, this happened pre-COVID. This happened post ILNFS. The conscious call the company took at that point in time is that lending to sectors within this universe of what we call essential goods, these goods will always be in demand. The variance of the demand is what is in question. You're not questioning whether there will be a demand for it or not. Whereas funding a luxury item or funding an iPhone, funding a home, etc., could or could not happen depending on this thing. But manufacturing of school bags will always happen.
Right.
Manufacturing of hosiery will always happen. Wholesale of that will always happen. Manufacturing of what we call, or even retailing of what we call home office retail, tiles, etc. Manufacturing of footwear. Those are the kind of things. Then you go across and we identify, do we want to be funding the retail chain of it, which means a retailer selling it to a consumer, or do we want to be funding the wholesaler, distributor, supplier, etc., which we thought is a better option for us, at least at that point in time. So in our experience, we thought that these are goods that will always have a certain level of demand, can we fulfill that level of demand being funded to these businesses?
Sorry, so the choice is wholesalers, distributors, or retailers? What's the
More on the wholesalers, retailers, suppliers point of view than the pure play retail. Pure
Got
play retail has, in our view, right or wrong, more cyclicality associated with it. This also has certain amount of cyclicality associated with it, but lower cyclicality. So we are happy, at least in our journey, we are happy funding this part of the business uh, at this stage of our evolution. So that's how we identified, the sectors that we wanted to be in. Initially, when we started, we funded almost 27 different sectors. Today, our focus is on 8 sectors. So those 8 sectors are where we have seen vintage, where we've done almost 5 years of lending. We've seen over 3 repayment cycles. We know
Right.
how the borrower behaves, or we feel we know how the borrower behaves. We can understand the business much better. We understand the margins of that business. That's how we have focused in. Again, sometimes better lucky than good. So I would say that was a conceptual thought we had post September 2018. It took us a while to put that down on paper and then execute it. But I think over the course of the last 4 to 5 years now that we've executed on it, we feel very confident of going deeper into it.
So what are the 8 sectors, if you don't mind my asking?
So we do home office retail, as I mentioned to you. We do non-home office retail. We do garments where we've done fairly well, and we do something called beauty, fashion, and apparel, which again is nothing high-end, no luxury items, but more what is used in daily items, medical stores, kirana stores, and a couple of others. So those are the 7 or 8 sectors that we have done well in.
So I had one question. Broadly, I mean, we've listed out these 8 sectors that you lend to a lot. One concern that is consistently played out is that what happens if these guys get conglomeratized, or a large Reliance or an Adani or somebody comes in and enters this space as let's take like retail as an example, right? Kirana store retail. Now you have a great number of players trying to organize retail by controlling the full supply chain, controlling the point of sale. So is that truly a risk for, if not all of these sectors, but at least some of these sectors where these MSMEs may get disrupted out by larger conglomeratized organizations?
That certainly is a risk in any financial services business. Now, from time to time in financial services, you will see over exuberance and under exuberance. The way we look at it, at least, is see, wherever you see tremendous opportunity, it eventually results in chaos, because you either dilute norms on lending or you dilute pricing. It's
Right.
one of the two. Wherever you see tremendous amount of chaos, it eventually results in tremendous opportunity as well over a period of time, because a lot of bad actors or a lot of um, bad lending, etc., happens, and then eventually that gets wiped out. So the way we look at it, at least, is see, India has always been a competitive market. I often People ask me this question: is it not competitive? Is it too competitive? If it's not competitive, there's something wrong with the geography, or there's something wrong with the product. In a place like India, because India is a big market, not just in terms of the demographic of demand, but also in terms of the supply of things, right? It's a big market. It'll always be competitive. The answer where lies in how you cater towards your customer, which is most important. So I often say to people, it's a very easily used term, customer service. Very hard to do. Very hard to do. It's all about customer service. Now, you could have big conglomerates that come and provide capital to these same people at a much cheaper cost. Fair point. At that point in time, people like us who have a higher cost of capital than them, many others will probably lose share. But we are so small that we at Truecap don't care about market share. It's inconsequential for me because I'm a very small player in the market. So for me, what's important is firstly being profitable. Number two, once you're profitable, how do you gain scale on those profits and continue to gain those profits? Because only then will I be able to lower the cost at which I lend to these customers. So
Right.
if we lose certain amount of business towards the others when it's getting overly competitive, we decide not to compete, right?
Right.
I may have a loss of revenue, but I'm also not then raising more debt, which is incurring less finance cost on my P&L, which kind of helps me. Now, as you get bigger, you may not have that luxury, truth be told, because then you'll have to compete, etc. At this point, when we don't have the problem, I feel eventually it's a zero-sum game. It all plays out over a period of time. So again, it's not about having to compete, it's about how I compete. So how you can compete How you can provide that service to the customer, what's the value add you give to that customer is most important. Sometimes only providing cheaper capital is not a value add to the customer. Initially, it may be, but if you don't have any service, if you don't have any value added benefits, if the customer doesn't see that they can get more from you other than just capital, then it may not be a winning proposition for them.
That makes sense. Yeah. So, but the line of question what I want to try and understand is more focused on understanding what's happening with your customers, with the MSMEs and MSMEs, because I think there's a lot of conversation that over the last 5, 7, 8 years, MSMEs have suffered badly because of, let's say, GST implementation, you know, COVID and the reduction of cash usage, digitalization of ITR filing, a lot of, demonetization as well. I don't think you were with Truecap at that point in time, but generally there's this perception that MSMEs are really not struggling. There's no real future for them. They're going to get disrupted out or competed out. As their partners, what are you seeing in what's playing out with MSMEs in this country?
We actually have a view that whatever you've said is 100% right. Like day to day, there are several challenges these MSMEs deal with. Absolutely no doubt on that. That's part and parcel of how they live on a day to day basis. It's a constant struggle. But at the same time, there are a lot of benefits that are accruing to this customer because of all the struggles that they're undertaking. So GST has helped streamline a lot of things for them. No doubt it's cumbersome for them to file it on a monthly basis, etc. But the benefits that is being accrued to them longer term are far more than the disadvantages on a day-to-day basis. We feel that the MSMEs of today are constantly striving towards the next strata in elevating their position towards becoming a slightly larger NBFC. Today, access to finance for these NBFCs has actually become easier, which somehow takes away our competitive strength, if you think about it. Because if access to finance for them is becoming easier, where there are more banks and more of the other organized players who are able to fund them, it makes it harder for people like us who try and cater towards the underserved and the underbanked in MSMEs. So no doubt from a day-to-day basis, there are challenges, but we feel with all that the government has undertaken in terms of whether it's GST, whether it's the ONDC, whether it is so many other things that they've done, the CGT SME Credit Guarantee Fund, I think a lot of benefits have accrued to the MSMEs. Now, can you revise all the benefits on day one? No. So they also have to take a more longer term view, which is what you have to do. So you don't just have to provide them physical capital. You have to provide them social capital. That's why we call it building social capital, because building that social capital, building the awareness on what they can get, how do they avail of these schemes, what do they need to do from a business standpoint also to make sure that they align to becoming much bigger in the future. You have to help them with those kind of things. So we have a separate impact team. That impact team reaches out to the borrowers. Firstly, not just telling them what to do. Before that, you need to understand what they do.
Yeah.
So it's an investment that you need to put in. Now, we have tried to adopt that approach. I wouldn't say that it's been foolproof or it's been, superior all throughout, but I would say that we are starting to see some benefit from it. So it's there. We are actually very bullish on the MSME space, not just because we are lending, but because we are seeing that people who have the ability to pay are actually paying well enough, and the ability to pay is becoming easier. It's the ones that you have to be careful about that don't have the willingness to pay. And there are more than enough MSMEs that want to take the money but don't want to give it back to you.
Yeah. So, like we said, let's take a longer view. You're very bullish on the MSME sector. So, where do you see this space evolving over the next 5 to 10 years? I mean, let's take the 8 sectors that you primarily lend to. Do you expect that a large proportion of these MSMEs will actually make that jump into the next strata and the base will grow? Or do you expect to see consolidation or, status quo? What does a 10-year future look like?
I think it takes time. It takes time. So we are bullish in the way of, with India growing the way it is, you'll see material contribution from the MSMEs continue towards the economy. That's one. Number two is that the base will grow. So these MSMEs will become bigger. At the same time, as they become bigger, you will also see consolidation. That's our view. The reason being that as you grow bigger, you'll also have to implement in place many other things that they didn't have to do earlier. That oftentimes is not very easy to do. At that point in time, there will be consolidation. So you'll see smaller players becoming bigger. How do the bigger players become even bigger? By consolidating amongst themselves, right? There'll be people who want to monetize their way and start something else again. So, at least my personal view, not the company view, is that the base will get bigger and there will be more consolidation. Not now, over the course of the next 2, 3, 4, 5 years, there will be consolidation, post which then the space becomes even bigger because then you get bigger players, right? When there's amalgamation, etc., of smaller players with each other, then the space becomes even bigger.
So you started out with 27 sectors and you've now come down to 8. So you've eliminated 19. Which 19 have you eliminated and why? Why that elimination? What allowed you to narrow this down?
Sure. I think, one was obviously seeing the vintage of the portfolio, seeing how those sectors have performed, and even within seeing how those sectors have performed, what is causing a change in their business or a change in our thought about the business is why we didn't fund. So a simple example I'll give you is salons. So we've seen a significant difference in funding a men's salon versus a women's salon, for instance. And we found the experience of funding men's salons to be much better than funding a women's salon. We found that funding a salon in tier 2 and tier 3 areas is more profitable for us versus funding a salon in tier 1 areas. And the reason we can attribute to that is it's a lot more competitive in tier 1 areas. Garments, for instance, is the other sector where we found funding ready-made garment stores is a completely different performance criteria versus funding the wholesale manufacturing and the vendor supply chain of garments, right? Even though the MSRP of the garments are very low, but there's a completely different performance criteria in retail versus wholesale. Funding dairy, for example, geographically also is a world of a difference between Maharashtra and Delhi, for example. So we've seen those. So that's how we hold down on certain sectors. Truth be told, it's part of a learning process. So that learning process has also taught us firstly what not to do, and secondly, when you're good at something, then you really go after that. So like they say in stocks as well, don't always sell your winners. You should ride your winners out. You actually sell your losers, because if you don't try to average it down, you sell your losers. So same way, if a sector is doing well for us, don't say, okay, I'm going to do another sector now and maybe more lucrative. You rather try and see what else you can do to cater towards that borrower. So you're giving a garment wholesaler or a vendor, etc., money to grow their business. What else do they need? What else can you give them to bring them into your ecosystem?
So I want to try and clarify. Is it more about focusing on the same class of borrowers and offering them more credit products, or is it more about moving up or down that particular value chain and finding more people in that more participants in that value chain rather, to try and lend the same product? What's the better strategy?
It's the latter. At least for us, the latter has turned out to be better. See, what you don't want to do also in a financial services business, especially, is overlever a customer, number one, right? So obviously you don't want to let your good customer go. So whatever they need, you will keep providing them, provided you see that payback. So you have to but you have to be very careful about not over leveraging them as well, because then that's a burden on them. So, and also how much debt can the business absorb? So the business may be doing very well, but if you've taken out excessive debt and you've constantly done that then will overburden the business.
Yeah.
So for us, what's helped is making sure you retain your customer, but at the same time, you have to widen out your customer base. You cannot be reliant only on a certain customer base to this thing. Now, it's very different from a personal loan product, for instance. Like in a personal loan product, at least the experience that we have seen with other lenders is you will give the same customer a loan for multiple products because their vintage in earlier products is good, because their demand is of so many things.
Yeah.
Now, that's a salaried customer. A salaried customer is very different from a self-employed customer. As a self-employed customer, what we have to be very careful about is over-leveraging.
Okay, that makes a lot of sense. So what's the future like for Truecap? What do you guys want to get involved in? I mean, you've had it's really fantastic. 40 crores to 1100 crores is a great journey. And I'm sure you guys have something planned over the next 5-year cycle. So where do you want to be in 5 years time? What do you want to have done?
The idea is now, over the course of the last 4 years especially, and I would say in those 4 years as well, a big hockey stick in growth. at least from a distribution standpoint, has come from August 2020 onwards. So 4 years. We built out the distribution network. We're about 122 branches today across 8 states. The idea now is how we stabilize this distribution platform and do two or three things. One is gain scale and profitability. I think that is critical for us. The reason being that the entire investment into building out the distribution infrastructure, both at the front end and at the back end, because there's a significant amount of tech intervention that has to happen as well to be able to process scale. You could bring in business at the front end, but if your back end can't process it, it's of no use. So we've built that. Now the idea is how do you gain scale and profitability from what we built? So how do we do that? We will do that by trying to become, um, service providers, what we call lending as a service for many other large lenders. So the reality, as I mentioned in the beginning of our conversation, is as an NBFC, we'll always be reliant on the capital markets or larger lenders for capital. That's the reality, be it banks, capital markets, retail investors, etc. So why not leverage that? Why not piggyback off the capital of larger lenders and provide a service to them by giving them access to our customer base? So what we call lending as a service. So that'll be point number two in terms of what we look to do over the course of the next 5 years. Having built out the distribution platform, which is number one. Number two is how do we hone it and how do we use the our co-lending relationships, which we have today with 4 large lenders, to continue to build up the book further. So I don't think there's anything substantially new that you'll see in our business, but what you will hopefully see and what we hope to or what we aspire to do is build a lot more scale and profitability in the business going forward. Product wise, I think we'll still continue to be focused on the same product that we are in, which is essentially a business loan product, which is either backed by gold or collateral free. In that, there'll be certain other nuances, certain variations like a supply chain financing product, for instance, vendor financing, etc., which is part of the business loan portfolio. And other than that, I think the only goal is scale and profitability, nothing else.
We've spoken about scaling Truecap up, lending as a service, but I'm going to try and push you for some hard target numbers because that's the real meat of it, right? Like you've done, I don't even want to say how many x, like 100x in the last 4 years. What what's the number target? Right now you've serviced 300,000 customers. Let's try a customer number. You've serviced 300,000 customers over the last 4 years. In the next by 2030, what is your heart desire? What's the customer target number you want to try and reach?
See, so the number of wanting to, I'll answer your question straight first. We obviously want to service more than 1 million customers by 2030. I don't think being able to cater towards another 700,000 new customers is what will be the most challenging part. Or to acquire the 700,000 customers. It's about being able to service 1 million customers, which will be hard. See, acquiring can still be easy or relatively easier. How you service those customers and keep them happy and retain them, because eventually retaining the customer will reduce your cost of acquisition going forward. The more customers you lose, the faster churn you have, your cost of acquisition keeps increasing because you have to constantly do that. So I think number wise, obviously wanting to cater towards 1 million customers and then retain them, that is an important priority. And more than just getting to that million customer number, it's about how we get there. Number two is I wouldn't want to personally give any hard targets in what numbers we want to achieve in terms of size, profitability, because truth be told, that's a function of two things. One is it's a function of the market. Number two is it's a function of what kind of capital you're able to raise, just given the fact that it's a capital intensive business. The eventual number is a true derivative, right? What is most important are the inputs. So the inputs of staying true towards lending, in the 1 to 25 lakh ticket size segment, the states that we are in, I think that's more important for us at this point in time. Like I mentioned to you, we're still very small, where you could probably see numbers grow in a larger percentage. So a 20% number growth may not be good enough for us, just given the fact that we come from a very small base. We're a much smaller player. As we get bigger, then that 20-25% profit growth, 20-25% AUM growth will become more important. But the like I said, the two most important priorities for us are scale and profitability. We do want to get there, but we do want to get there in a manner that is controlled. it's a lending business. A lending business is an extremely responsible business. You can amp up growth very fast, but then you have to bear the consequences later.
Right.
So we want to have it, we want to do it in a calibrated and a measured way. And we're here to create, hopefully, an institution in the long term. As I say, hopefully, an institution in the long term. There are many examples before us where companies have started, be it in financial service institutions, 1996, in 2003, etc., that have made large that have become large financial institutions today, right? They weren't institutions earlier. They were companies that have become institutions. Our goal is to become an institution. It'll be hard for me to quantify saying that I want to become an institution 5 years, 6 years, 7 years. I think that's a function of the market as well.
Well, we here at Paisa Smart, we absolutely wish you all the best, and we're truly praying on your success. And we would love to see you here back at the podcast, celebrating, I guess, the next 100,000 or million or whatever customers it might be. And thank you so much for coming on the podcast, Rohan. It's been a pleasure to talk to you. I've had the opportunity to learn a lot, and I'm sure our viewers have learned a great deal as well from this as well.
Thank you so much for having me here. Firstly, we really appreciate it, and thank you for everyone for listening. Look forward to speaking again, and love being here. Thank you.